Hello there, welcome to David's Investment Analysis channel. Today I'm very excited to be doing something a little bit different. Today I'll be providing an update on all the SPACs I've talked about on this channel, including an updated current valuation and whether I still think the stock is a buy at its current price and whether I own any shares of the business myself. And at the end, I'll rank them in order of my preference. I do spend a lot of time preparing for these videos, so I really appreciate if you could like and share my video. And if you do not want to miss out on a future video, please do subscribe and click the bell notification. And when I do reach 2,000 subscribers, I will review my top 7 holdings in my portfolio. So if you do not want to miss out on that, please do subscribe and click the bell notification. And if there's any other company you'd like me to cover in the future, please do leave it in the comments below. Now let's get to it. First one is FMCI, which is planning to merge with Itella International, a plant-based food company, to form Tattoo Chef. The transaction is expected to close sometime in the third quarter of 2020. Since my last video, there's been a few updates. On June 25th, per Fly.com, Tobin Smith of Change Wave Investing believes that Tattoo Chef is worth significantly more than the current price of FMCI. On this day, the stock price went up from $15.20 to closing at $17.95. That's an 18% increase for the day. Tobin Smith is a successful author, anchor, and a market analyst with a wide follower. So this news is very positive for FMCI. After the spike on the news, the stock price drifted lower, closing at $13.12 on Friday, July 24, 2020. On Monday, July 27th, it was announced that Tattoo Chef reported preliminary revenue for the 6-month period ended June 30th, 2020 of $65.2 million, a 96% increase over the prior year comparative period. The company's strong Q1 revenue of $33.2 million, a 95% increase over Q1 2019, was followed by an estimated Q2 revenue of $32 million, a 96% increase over Q2 2019. These are amazing growth numbers, and the stock reacted favorably, going up from $13.12 to $15.30, a 16.6% increase for the day. Let's look at the updated valuation compared to Beyond Meat. The market cap of Beyond Meat is $7.8 billion. FMCI is $845 million. FMCI has a better price to earnings, price to estimated sales, profit margin, operating margin, and net cash as a percentage of market cap compared to Beyond Meat. Beyond Meat trades at 2.88 times more expensive than Tattoo Chef on a price to estimated 2021 sales. If we use the same valuation of Beyond Meat, the FMCI shares would trade at $42.45, representing a 188% upside. To be conservative, even if it trades at half its valuation, the stock price should trade at $21.22, representing a 44% upside. In my opinion, at today's price of $14.70, I think it is a buy because of the following reasons. Tattoo Chef is a fast-growing plant-based food company that is expected to grow around 13% a year. Tattoo Chef, they plant, grow, and manufacture, handling the product from the fields to the consumer hands. This allows them to control the supply chain and what goes into their foods. Tattoo Chef has amazing growth. Sales grew 77% in 2019 and is expected to grow 74% this year, 2020. Their Q1 2020 grew 95% and their Q2 2020 grew 96%. They have several opportunities to grow. They can grow within the US through distribution of additional retail and grocers, or through additional product offerings and into other areas such as desserts and meat alternatives, or internationally through their current partnership retailers and grocers. They have a very cheap valuation compared to Beyond Meat and a strong balance sheet to help them grow in the future. But also bear in mind of these concerns and risks. Global health issue may impact supply chains. Tattoo Chef have competition for frozen aisle with many small startups and large multinationals. The transaction is still subject to approval and closing conditions. If the transaction falls through, the stock price will go back to $10. There can be difficulties to expand internationally and add new product offerings because of competition. The raw materials such as food depends heavily on weather conditions. Disclosure: I do own some shares of FMCI. I've done an in-depth analysis of FMCI and Tattoo Chef. If you would like to watch it, please click the link at the top right or the link in the description. Second one is OPES, which is planning to merge with BurgerFi. The transaction is expected to close sometime in the third quarter of 2020. Since publishing the OPES video, they announced their definitive agreement on June 30th, and at the same time provided the investors presentation that included some of the financial numbers. Here's a few highlights from the presentation. I left a link in the description if you'd like to review the full presentation. In addition to the previous video on OPES, they provided an aggressive store growth plan, planning to open 30 company-owned units and 24 franchise units in 2021. This is a huge increase from the current total of 125. Here is a summary of the previous financial results of BurgerFi and its projections for 2020 and 2021. The company's revenue is expected to grow at a compound annual growth rate of 36.4% from $31.9 million in 2019 to $59.3 million in 2021. And adjusted EBITDA is expected to grow at a compound annual growth rate of 77.2% from $3.3 million in 2019 to $10.5 million in 2021. Here is the pro forma valuation of the merger transaction. The enterprise value is $143 million based on a multiple of 13.6 times 2021 estimated EBITDA and 2.4 times 2021 estimated revenue. Current BurgerFi shareholders will roll over majority of their ownership. There's $48 million coming from the OPES Trust plus private placement of $30 million, less $30 million to initial shareholders, less transaction fee of $6 million leaves approximately $43 million that will be added to the combined company's balance sheet. The agreement also has several earnouts that would possibly dilute shareholders' equity because of the issuance of shares. The earnouts are based on certain price levels within the first 2 to 3 years after closing the transaction. And on July 13th, they announced some numbers related to the delivery business. We can see here that the delivery sales has increased significantly this year due to the global health issue. We can see in May their delivery sales has increased over 111%. It will be also interesting to know how the rest of the business is doing. Since the release of the definitive agreement on June 30th, the share price of OPES dropped from $15.99 to $11.13 at the end of the last trading day. Let's look at the current valuation compared to Shake Shack. The market cap of Shake Shack is $2 billion. OPES is $196 million. OPES has a better price to earnings ratio, but a worse price to sales ratio. However, OPES has a better projected growth compared to Shake Shack, and if we look at the price to sales to growth, OPES trades at a more reasonable valuation. BurgerFi also has better margins and is in a better cash position as a percentage of market cap. If we use the same price sales to growth ratio as Shake Shack, then OPES should trade at $31.97, representing a 187% upside. If it trades at half its valuation, the stock price should trade at around $15.99, representing a 44% upside. But please note that the growth rate is wildly different between the two, and a change in this number can change the valuation significantly. I believe the stock at $11.13 is a speculative buy for the following reasons. BurgerFi has good growth rate and is growing faster than industry and faster than many competitors, which suggests they are increasing market share with the fast food industry space. They have a strong growth initiative suggesting intention to grow within the U.S., grow through partnerships with the American Air Force, investing in e-commerce, and ghost kitchens. BurgerFi have already been able to adapt during this global health issue. Many consumers are more cautious of where their food comes from, and BurgerFi has been able to capitalize on this trend. They are committed to transparency and have a desire to avoid antibiotics, steroids, chemicals, and additives in their food. And this has really built a reputation, and they are ranked one of the best burger joint by Chain Reaction Report. BurgerFi is run by a lawyer and a successful entrepreneur, which leads me to believe that they have a strong management team. They also have a very reasonable valuation based on the projections, and likely a strong balance sheet to support its growth. However, there are some risks with BurgerFi. Although BurgerFi has been able to adapt and is currently growing with many growth initiatives, the global health issue most certainly would have some impact on their business. It would be very interesting to know how much it has impacted their sales from the store closures and reduced operating hours. The fast casual restaurant industry is very competitive, as its barrier to entry is low. And not only does BurgerFi compete with large multinational chains, they also compete with the small restaurant owners. The growth potential does look very promising, but remind you that those projections are only estimates and that the reality can be very different. Despite the reasonable valuation, if the deal does fall apart, the stock price would go back to $10. The transaction is still subject to shareholder approval and closing conditions. Disclosure: I do not own any shares of OPES. I have done an in-depth analysis of OPES and BurgerFi. If you would like to watch it, please click the link on the top right or the link in the description. The next one is SHLL, which is planning to merge with Hyliion. The transaction is expected to be closed at the end of the third quarter of 2020. Since my last video on Hyliion was published, there's a couple of updates. On June 25th, it was announced the confirmation of the 1,000 trucks ordered by Agility, and has also agreed to invest in a private offering of securities to be issued by Tortoise Acquisition Corp. In connection with the recently announced business combination. Hyliion CEO said, "Our practical solution addresses the most important needs of today's fleets: cost savings, lower emissions, and a fueling infrastructure that can support the long-haul transportation. and we're already seeing robust interest in the Hypertruck ERX from fleets like Agility. The CEO of Agility said, "The Hyliion technology is so game-changing that all companies, especially those with consumer-faced brands, will be forced to adapt. And it's a triple win: protect the environment, keep customers happy, and benefit shareholders by improving the bottom line. We look forward to bringing significant cost savings and greater efficiency to our customers." And just recently, July 30th, they announced the appointment of Andrew H. Card Jr. to join the board of directors of the combined company. Card's nomination to the combined entity's board follows a respected career in public service under President George W. Bush. Card is the former president and CEO of the American Automobile Manufacturers Association, a trade association for the U.S.-based automobile manufacturers, and previously served as the vice president of government relations for General Motors. He is currently on the boards of directors for Union Pacific Railroad, a position he has held since 2006, and Dragonfly, an industry-leading manufacturer in the commercial drone industry. It appears to be positive that the combined company just added a well-experienced individual to its board. Since the release of the merger on June 19, 2020, the stock price of SHLL went from $10.22 to as high as $34.67 on June 29th. Before falling back down to closing on the last trading day of $19.33. Let's look at a more up-to-date valuation amongst the group. The current market cap of Nikola is $10.8 billion, NIO is $14.1 billion, Tesla is $266.6 billion, Fisker is $3.6 billion, and Hyliion is $3.1 billion. Looking at the price to estimated 2023 and 2024 sales ratio, Hyliion's valuation is reasonable amongst the group. Hyliion also has a strong cash position as a percentage of market cap. While the valuation appears to be very attractive, but please note that these valuations are based on management's projections of revenue. Interested investors should consider whether these projections are reasonable and apply some level of margin of safety. Conclusion. In my opinion, at today's price of $19.33, I think it is a buy because of the following reasons. Hyliion's Hypertruck ERX is a net negative carbon emissions truck that offers greater performance, longer range, shorter refuel time, more payload capacity, and cheaper refuel costs. There is a network of natural gas stations already available across the US. They have a great proprietary technology with the ability to recharge battery with what would have been wasted kinetic energy to power the vehicle. As people move away from diesel vehicles becoming more cautious of the environment, there will be a high demand for natural gas trucks. And there is currently no big manufacturers of natural gas trucks, so the potential is huge for Hyliion. They already have a binding pre-order of 1,000 trucks with a large global logistics company. They also have a very experienced management team, some with over 20 and 30 years of experience. They currently trade very reasonable valuation compared to competitors, approximately 1.5 times 2024 sales, with a very strong balance sheet of approximately $520 million of cash. Here are some of my concerns. The risk with the global health issue and the possibility of decreasing demand for trucks or companies delaying the upgrade of fleets. Competing with Tesla and Nikola. Tesla is well established and have been in the electric vehicles for many years. Competition is good for consumers, and now consumers have more choices and perhaps finally shift from diesel trucks to these alternatives. I also believe that there is sufficient market shares for all three players to do well. Natural gas trucks have been around for some time now, and they have not been able to take off because of various reasons, and Hyliion may run into similar reasons. A big risk is if the deal falls apart, the share price would go back to $10. The transaction is still subject to shareholder approval and closing conditions. Disclosure: I do own some shares of SHLL. I've done an in-depth analysis of SHLL and Hyliion. If you would like to watch it, please click the link on the top right or the link in the description. Next one is CRSA, which is planning to merge with F45. The transaction is expected to close sometime in the third quarter of 2020. There has been no updates, and the shares of the company stayed at around $10 range. As mentioned in my previous video, the price is likely would be around this range unless there is some positive news from CRSA or F45. Looking at the updated valuation compared to Planet Fitness, the market cap of Planet Fitness is $4.1 billion and F45 is at $896 million. It appears that F45 trades at a more expensive current price to earnings ratio and a price to sales ratio, but if we look forward, it appears to be cheaper, and it is because management projects that F45 will have a faster growth rate compared to Planet Fitness. F45 appears to have a strong balance sheet compared to Planet Fitness. In my opinion, at today's price of $10.50, I think it's a speculative buy because of the following reasons. Strong management team led by Adam Gilchrist, who appears to be a successful entrepreneur with a few successful businesses. F45 has been able to grow very rapidly, growing faster than the industry, which suggests that the company has been taking market share, and the projections suggest that it will continue to outgrow the industry by a large degree. F45's success is driven by both members and franchisees. Members appear to enjoy the workouts and average 2 to 3 visits per week, and franchisees see a low cost and a high return on investment. F45 shared some encouraging statistics as the studios start to reopen back up after the global health issue. F45 has a well thought out 7 growth initiatives to drive its growth plan. F45 has a celebrity investor, Mark Wahlberg, that continues to introduce other celebrities to F45, which increases F45's image and reputation. They have reasonable valuation and the stock price trades at $10.15. That appears to be limited downside prior to the closing of the transaction because shareholders are able to redeem the shares for $10 each. Some of my concerns include the risk with the global health issue, and this is the biggest concern I have, as this would significantly impact the business due to the closures of the F45 studios, and a second wave may prolong the closures. It would also be very interesting to see whether there is a permanent shift from consumers to prefer working out at home as opposed to at the studio. One of the most important factors is whether members will continue to go to studios when they reopen, and whether there is a demand for F45 studios. The growth potential looks very good, but remind you that the projections are only estimates and that the reality can be very different. Competing with Planet Fitness. Planet Fitness is well established and have been in the fitness industry for many years. Competition is good for consumers and now consumers have more choices, but they would definitely limit F45's ability to grow. But with the recent filing bankruptcies by competitors, this allows F45 to capitalize on potential opportunities. If the deal does fall apart, the shares will go back to $10. The transaction is still subject to shareholder approval and closing conditions. Disclosure. I do own some shares of CRSA. I've done an in-depth analysis on CRSA and F45. If you would like to watch it, please click the link at the top right or the link in the description. Next one is LCA, which is planning to merge with Golden Nugget Online Gaming. The transaction is expected to close sometime in the third quarter of 2020. Since my last video on Golden Nugget was published, there's a couple of updates. On June 30th, there was an article from Real Money. In the article, it suggests that Tillman Fertitta took a $300 million loan to help his entertainment empire, and this loan is absorbed by the new combined entity, and that half of the loan will be paid with cash in the SPAC trust, while the other half will be assumed by the merged company. While this sounds very negative, but I wasn't able to confirm whether this is true, because it does not mention in the investor's presentation or agreements related to the Golden Nugget Online Gaming merger transaction. So I'm curious where the author got this information. There are confirmations that Tillman did take out a $300 million loan, but it did not say it was through Golden Nugget Online Gaming. And while it does suggest that the agreement that $150 million of the loan is repaid with the cash in the SPAC trust, but it doesn't say that the $150 million is part of the $300 million loan. If GNOG did take out the $300 million loan and then subsequently loaned it to Tillman's other business to help it get through the difficult time during the global health crisis, on GNOG's financial statements, they should have an asset loan receivable that should offset the loan payable. And at some point in the future, when GNOG does need the cash, the other parties will repay back this loan. Tillman wants all of his business to succeed, and GNOG would be included. Next, on July 19th, it was announced that Roundhill Sports Betting iGaming ETF, ticker BETZ, added LCA to its portfolio at a weight of 2.52%. Overall, this is positive news because management of the fund believes on the outlook of the merger and is adding to its portfolio. Let's look at the updated valuation compared to competitors. The market cap of DraftKings is $11.8 billion, GAN is $560 million, DMYT, another SPAC, is $2.1 billion, and LCA is $785 million. GNOG and Rush Street Interactive both trade very reasonable compared to DraftKings and GAN Limited from a price to sales ratio, and both have a strong cash as a percentage of market cap. In my opinion, at today's price of $11.50, I think it's a speculative buy because of the following reasons. Strong management team led by Tillman Fertitta, who is an established billionaire entrepreneur who owns the Houston Rockets in the NBA. GNOG has been able to grow very rapidly, remain profitable, growing faster than the industry, which suggests that the company has been able to take market share, and the projections suggest that they can continue to outgrow the industry by a large degree. GNOG plans to expand from New Jersey to Pennsylvania and Michigan in the near term, and to the rest of the U.S. longer term. GNOG has strong brand loyalty, increasing membership in Landry Select Club and Golden Nugget 24K Select Club. GNOG has innovative products including their live dealer studio, which has expanded from 4 tables to 18 tables. And GNOG has intention to release 80 additional exclusive games within the next 12 months. They have a reasonable valuation compared to its competitors. GNOG is currently trading at approximately 6.4 times 2021 sales. Some of my concerns include the global health issue has accelerated their business, but as the states start to reopen, there will be a significant drop in the number of active users. The growth potential looks very promising, but remind you that the projections are only estimates and that reality can be very different. Stringent regulations related to the online gambling are expected to hinder the market growth, and staying compliant with regulators can sometimes be challenging. GNOG is competing with DraftKings, RSI, GAN, and several other players. Competition is good for consumers as consumers now have more choices, but would definitely limit GNOG's ability to grow. With a recent global health issue and more people staying at home, this allows GNOG to capitalize on the potential opportunity of retaining active users. Despite the reasonable valuation, if the deal does fall apart, the shares will go back to $10 per share. The transaction is still subject to shareholder approval and closing conditions. Disclosure: I do own some shares of LCA. I've done an in-depth analysis on LCA and Golden Nugget online gaming. If you would like to watch it, please click the link at the top right or the link in the description. The next one is GRAF, which is planning to merge with Velodyne Lidar. The transaction is expected to close sometime in the third quarter of 2020. Since my last video on Velodyne Lidar was published, there hasn't been too much update, but there's one thing that's very interesting. There has been several law firms investigating the proposed merger, looking to see whether the board of directors breached its fiduciary duties to the shareholders by failing to conduct a fair and adequate merger process, and whether and how much of the proposed transaction undervalues the company. While it's common sometimes to have law firms to investigate the merger transactions or acquisition transactions, it's interesting to see the number of firms that are interested in investigating this deal. Let's look at the current valuation. The shares closed at $13.50. With the pro forma of 172.3 million shares, the company would be valued at $2.3 billion, which is near the low end of the management's valuation. If we look at the low end of management's valuation of $2 billion, the share price would trade at $11.61, which is a 16% downwards from where it is today. With the high end management's valuation of $3.6 billion, the share price would trade at $20.89, which suggests an upside of 35%. In my opinion, at today's price of $13.50, I think it is a buy because of the following reasons. They have a strong management team led by David Hall, who is a serial inventor that invented the 3D Lidar technology that give autonomous vehicles real-time 360 degrees vision. Velodyne has been able to grow very rapidly, growing faster than the industry, which suggests that the company has been taking market share, and projections suggest that they can continue to outgrow the industry by a large degree. Velodyne is currently tracking 165 projects that would use the LiDAR technology, and 16 contracts have been signed already. And as time progresses, the number would continue to increase. Velodyne is backed by large strategic investors like Ford, Baidu, Nikon, and Hyundai. Velodyne has a very sticky customer base because customers spend years and millions in developing solutions around Velodyne's technology, and most of the time have long-term contracts. Their technology and products and manufacturing methods are protected by their competitive global patent portfolio. Velodyne has a very broad range of product offerings for several industries at low cost, from hundreds to thousands of dollars, that are durable and can last over 10 years in harsh environments. Velodyne has a reasonable valuation compared to its competitors, and is at the low end of the management's valuation. Some of my concerns include the global health issue may impact supply chains and lower demands in certain industries like the oil and gas exploration. The growth potential does look very promising, but remind you that projections are only estimates, and that reality can be very different. There can be some industries that may be unaware of the technology and its benefit, or believe that it's very expensive, have limited use, and it's not durable. There may be other alternatives to LiDAR solutions, like Tesla using vision and radar in autonomous driving as opposed to LiDAR. Despite the reasonable valuation, if the deal does fall apart, the shares will go back to $10. The transaction is still subject to shareholder approval and closing conditions. Disclosure: I do own some shares of GRAF. I've done an in-depth analysis on GRAF and Velodyne Lidar. If you'd like to watch it, please click the link at the top right or the link in the description. Next one is SPAQ, SPAQ, which is planning to merge with Fisker. The transaction is expected to close sometime in the fourth quarter of 2020. Since my last video on Fisker, there hasn't been too much update, but there is one major one. Just on July 31st, in a roadshow script filed with the SEC, it said, "It is also a reality when working with world-class partners that they might not move at our speed. To this point, we have not achieved our goal of signing a cornerstone agreement with Volkswagen by the end of July 2020, as we previously anticipated. We look forward to continued discussions with Volkswagen again in September, after the traditional European summer holidays. We remain in conversation with several other potential OEMs and suppliers that will be able to fit within our unique business model, and we believe will enable us to enter into definitive manufacturing and supply agreements before year end." Following the announcement, the stock price dropped more than 10% on the trading day. As mentioned in our previous video, one of the critical pieces is the partnership with Volkswagen, and now that is delayed. Let's look at a more updated valuation. The current market cap of Nikola is $10.8 billion, NIO is $14.1 billion, Tesla is $266.6 billion, Hyliion is $3.1 billion, and Fisker is $3.6 billion. Looking at the price to estimated 22, 23, and 24 sales ratio, Fisker's valuation is reasonable amongst the group. Fisker also has a strong cash position as a percentage of market cap. While the valuation appears to be very attractive, but please note that these valuations are based on management's projections of revenue. Interested investors should consider whether these projections are reasonable and apply a level of margin of safety. In my opinion, at today's price of $12.32, I think it's a speculative buy because of the following reasons. Fisker is in the EV industry that is expected to grow 20-30% annually, so the opportunity would be there for Fisker to grow. There's a lot of excitement for this industry with the recent huge surge in EV stocks like Hyliion, NIO, Nikola, and Tesla. Fisker is now another option. I believe there is enough demand for several successful EV companies that can coexist in the industry. Fisker has some amazing projections and is set to grow faster than the industry, suggesting it will take market share from other competitors. Henrik Fisker, who is the CEO, is an award-winning designer that will have the best designs for their upcoming vehicles. They also have the knowledge and resource support from Apollo Global Management. Fisker Ocean is expected to be the world's most sustainable vehicle using recycled rubber from tire manufacturing waste, EVO Sway interior made from recycled polyester, and carpet made from fishing nets and bottle recycled from the ocean waste. Fisker is in negotiations with Volkswagen to use MEB electric vehicle platform, sourcing of parts, and manufacturing capabilities which will reduce time and cost for Fisker. Fisker developed Flexi app to provide consumer with digital experience, from configuring and purchasing the vehicle to scheduling for service and pickup. They have a very reasonable valuation compared to competitors, with $1 billion of cash on its balance sheet used to bring Fisker Ocean to production. Some of my concerns include the failure of Fisker Automotive presents a risk for the management team's ability to run a successful public company and executing on the plans discussed previously. Having said that, perhaps second time is a charm, and this time they have some strong resources to help it succeed. The lack of standardization of charging infrastructure and general high cost of EVs, stringent rules for installation of charging stations, and limited range of EVs present a risk to slow the growth of the EV industry. The growth potential looks very promising, but reminds you that the company currently does not have any sales and the projections are only estimates and can be very different from reality. There's a huge reliance on a partnership with Volkswagen, and there's no definitive agreement signed yet. Many of the functions are outsourced, so it would be very interesting to see how it will hurt margins and how Fisker can control the quality of the vehicles being manufactured. Despite the reasonable valuation, if the deal does fall apart, the shares will go back to $10. This transaction is still subject to shareholder approval and closing conditions. Disclosure: I do not own any shares of SPAC. I've done an in-depth analysis on SPAC and Fisker. If you would like to watch it, please click the link at the top right or the link in the description. And the last one and my most recent one is DMYT, which is planning to merge with Rush Street Interactive, RSI. The transaction is expected to close sometime in 2020. Since my last video on RSI was published, there hasn't been too much to update. Let's look at the updated valuation compared to the competitors. The market cap of DraftKings is $11.8 billion, GAN is $560 million, LCA is $785 million, and DMYT is $2.1 billion. RSI and GNOG both trade very reasonable compared to DraftKings and GAN Limited from a price to sales ratio, and both have a strong cash position as a percentage of market cap. In my opinion, at today's price of $10.59, I think it is a speculative buy because of the following reasons. They have a strong management team led by co-founders Chairman Neil, CEO Greg, President Richard, who are knowledgeable and experienced. They all have been with RSI since the beginning in 2012. Not only that, they also have DMYT technology management team on its board of directors. RSI is in the online gambling industry that is expected to grow 9% to 11% annually for the next several years, so the opportunity would be there for RSI to grow. RSI has some amazing projections and is set to grow faster than industry, suggesting they will take market share from other competitors. RSI is the #1 US online casino based on gross revenue for May 2020. RSI has strong growth catalysts like geographic expansion, product diversification, leading KPIs, digital user acquisition, and tuck-in acquisitions. RSI has a proprietary tech platform that allows flexibility and rapid feature creation and/or integration. RSI has a reasonable price to sales ratio and a strong balance sheet compared to competitors. And here are some of the concerns. The global health issue has accelerated their business, but as states start to reopen, there may be a significant drop in the number of active users on their online casino. The growth potential does look very promising, but remind you that the projections are only estimates that can be very different from reality. Stringent regulations related to online gambling are expected to hinder the market growth, and staying compliant with regulators can sometimes be challenging. Competing with DraftKings, RSI, GAN, and several other players, competition is good for consumers as consumers now have more options, but would definitely limit RSI's ability to grow. But with the most recent global health issue and more people staying at home, this allows RSI to capitalize on potential opportunity of retaining active users. Despite the reasonable valuation, if the deal does fall apart, the shares will go back to $10. The transaction is still subject to shareholder approval and closing conditions. Disclosure: I do not own any shares of DMYT. I've done in-depth analysis on DMYT and Rush Street Interactive. If you'd like to watch it, please click the link at the top right or in the link in the description. Now let's rank all the SPACs discussed, starting with the 8th spot. At the 8th spot, I ranked CRSA or F45. Reason being that they unfortunately are in the industry that will experience challenging times during the global health issue. I own a small position in this because the downside is limited in the next couple of months, and they have very good growth numbers prior to the global health issue. In 7th, I ranked OPES or BurgerFi, and the reason is similar to F45. They unfortunately are in the industry that will experience challenging times in the near term. I would have likely ranked this 8, but the valuation has come down significantly and now trades at a reasonable valuation, so I ranked it above CRSA. And in the 6th spot, I ranked DMYT, Rush Street Interactive. It was a pretty close between LCA or Golden Nugget Online Gaming, but I ranked LCA slightly higher because they are actually profitable right now, and RSI's growth projections seem a little bit too optimistic to me. And in the 5th place, like I said, I ranked LCA, Golden Nugget Online Gaming. Like mentioned earlier, it was pretty close compared to RSI. I feel that GNOG's growth projections is more attainable and has positive earnings last year and the previous quarters. To be honest, I think either one is good if you like the iGaming industry. And in the 4th place, I ranked SPAC or Fisker. I was contemplating ranking this after LCA or DMYT because of the recent announcement of the delay in signing the agreement with Volkswagen. But when I looked at the future of the EV industry, I can see Fisker can significantly benefit from it, and the agreement is just delayed at this point and not cancelled. And in the 3rd place, I ranked GRAF, Velodyne Lidar. I really like their sticky business, and they are a leader in the Lidar industry, and their growth potential looks very promising. And in the 2nd place, I ranked FMCI, Tattoo Chef. It was actually very close with Hyliion. Tattoo Chef has a proven business that is growing at 95% in Q1 and 96% in Q2, and the projections for 2020 is only 74%, which to me is realistic and achievable. This is really good growth, and the price of the stock trades at a very reasonable valuation, so I see a lot of potential in FMCI. And in the 1st place, I ranked SHLL or Hyliion. It was a bit difficult because Hyliion still needed to prove itself that it's a viable business. But I really like Thomas Healy, the CEO. I watched several of his interviews and I think this guy is a smart guy. This one to me is a bit riskier than FMCI, but I see a bigger potential for it, especially in the EV truck industry that they are in. Please let me know in the comments below if you agree with the rankings, and if not, how would you have ranked it? That's it for now. Once I reach 2,000 subscribers, I will review my top 7 individual stocks holding in my portfolio. If you do not want to miss out on that, please do subscribe and click the bell notification. Thank you for watching. Until then, see you next time.